Macroeconomic markets this morning are higher, continuing in uncharted record territory. The Dow Industrial is up another 29, the S&P up 1.25, and the Nasdaq higher by 25 after we hit new record highs in yesterday's trading session. Partly due to tech. Advanced Micro Devices, AMD, is surging again this morning after rising better than 23% yesterday. Another 4% rally this morning following a 5-year multi-billion-dollar computing deal with OpenAI. OpenAI will take a 10% stake in AMD to help expand its chip rollout. Earnings season is also kicking off this week. We've got Delta coming out on Thursday, and then next week it will be a focus on major banks. JP Morgan, Goldman Sachs, Citigroup, Bank of America will all report next Tuesday. Analysts are expecting S&P 500 earnings to be up about 5% year over year, led by technology and financials. Joining me now is Ironsides Macroeconomic Managing Partner and Director of Research, Barry Knapp. Barry, great to see you. A lot to talk about in terms of catalysts for this market, whether it be third quarter earnings season about to kick off or the Federal Reserve cutting interest rates. What's your view for the fourth quarter and the year overall?
I think I agree with Mr. Lee that the market is likely to rally through the balance of the year. I do think that the most important driver, the sectors I would expect to perform best would be actually the Russell and small bank, Russell 2000 that is, and small banks, perhaps outperforming technology the rest of the way, at least through the balance of the year. As we get those rate cuts, the impact of rate cuts on return on equity profitability for small banks is going to be really profound. A year ago, when we went from that deep inversion and the Fed cut 100 basis points, return on equity jumped from 5% to 7.5%. This year, another 100 basis points of rate cuts will push that return on equity above 10%, which will allow them to earn out their cost of capital, start building assets again, accumulating mortgages, tighten the spread of mortgages to treasuries. It'll start a rebound in the housing market. So to me, that's the most exciting part of the story now. I know everyone sort of focuses on tech right now, but that story is getting increasingly difficult. We're not at the point where, I would argue we're 1999 yet, but when you see, all this vendor financing going on, the cross investment deals, it is a sign that, it's getting increasingly speculative. We haven't reached the points that we got to in 99 or 2000 where the telecom sector was spending some 80% of their cash flow on capital investment. They're only at about half that level right now. But nonetheless, I think that tech story is getting a little tired, and I prefer the cleaner, cheaper story, which is Fed rate cuts really boosting profitability for small companies and small banks in particular.
Well, you also have the potential for consolidation, right? You saw a major deal yesterday among two regionals, and that certainly moved those stocks. Do you expect consolidation to be part of the banking story as well for the smaller banks? The larger ones are already up against their cap on deposits.
I do. I think there's three elements to the overall banking story. One is the regulatory environment, and that's going to continue to get looser for the next 3 years, regardless of what happens in midterms. I would suspect that Treasury Secretary Bessent, maybe it's even a good question for you, when he interviews people for Fed chair, I suspect one of the most important questions is, what is your view around bank regulatory policy? Because Treasury Secretary Bessent's been quite clear. He thinks that that's really important. So a looser regulatory environment for the big banks and for the smaller regional banks is crucial. And I think it will be a tailwind for them. You rightly point out M&A for the smaller banking sector is going to be a real tailwind. And then, as I said, a steeper yield curve for those smaller banks is going to really boost profitability.
What do you think is going on today with this spike in short-term yields? The 10-year is up 2 basis points right now, Barry. I want to get your take on interest rates and how many cuts you're expecting. As we're all expecting the Fed to cut rates, the yield on the 10-year is up 2 basis points, sitting at 4.16%. We also want to mention that we've got more to the tariff story. The president is imposing 25% tariffs on all medium and heavy-duty truck imports beginning November 1st. This move could impact companies such as Stellantis, Daimler Truck, Volvo, and PACCAR, and also countries such as Mexico, the largest exporter of heavy trucks to the U.S.
Right, two really important concepts. Right now, I think the little bit of pressure we're seeing on the back end of the Treasury market is really related to global factors. It's the election in Japan caused a big spike in JGB yields. The Japanese are the biggest global investors in fixed income. You know, it's a relative competitiveness story, right? If 30 and 40-year JGB yields are up a lot, there is an inclination for them to sell U.S. Treasuries and bring the money home. That's part of the story. The problems in the French government putting upward pressure on the back end of the Treasury market. I'm not really concerned about our Treasury market right now. The conditions are completely different than a year ago. All the concerns about excess supply really have dissipated. And so I think the Treasury market's fine. And as I said, if we do get the rate cuts, that's going to really create small bank demand for mortgage-backed securities, which is going to boost the Treasury market. So Treasury market's fine for me. The tariff story is a little, is sort of taking a different tact here. We've been avoiding any of the consumer-facing sectors, so consumer discretionary, which would include Stellantis, auto companies for sure, consumer discretionary, and consumer staples companies all year. And you could see pressure on profit margins from these tariffs. There's no ability to pass prices through to the final consumer. It's why inflation has been coming down, and inflation break-evens are unchanged this year. So I would still avoid those sectors. I suspect you'll get some people to buy them out of earnings season thinking, okay, this is the worst of it, it's over. But that effect is still going to linger. The effective tariff rate's gone from 2.5% to 12. It's probably going to 15. So there's still some more to be absorbed in profit margins and by, of course, the exporters in China and Mexico and the like. So I'd still stay away from those sectors and focus on things that will benefit from stronger investment as a consequence of the big, beautiful bill act. So that's sort of how we're positioned, is long industrials and short the other stuff.
Any thoughts on Japan now that we've got the first female prime minister on her way in? Larry Lindsay yesterday from the Lindsay Report wrote, President Trump will find Ms. Takaichi offers both a very useful ally in his confrontation with Xi Jinping and a tough negotiator on bilateral trade and economic relations. To put it in Trumpian terms, she is setting out to make Japan great again. Barry, any thoughts there in terms of this new prime minister, first female prime minister in Japan?
Yeah, no, it's quite a cultural change there for sure. We're long Japan. I like the equity market. My understanding is she's fancied herself a Margaret Thatcher disciple, which, of course, would really thrill me. But, we'll see. There's lots of concerns. Oh, she's going to borrow money. She's talking about cutting taxes. It's always viewed by the left as the same thing. It's not the same thing. Cutting taxes drives private sector investment, productivity, and is a big net positive. If she's going to lower tax rates, I'm all in on her, and I'll probably add to my Japanese position.
Yeah. Do you care about the U.S. government shutdown yet?
I missed the payroll report, but other than that, not really. Government spending. Listen, Medicaid spending went up 50% from 2019 through 2024. Government spending has to be put on a path back to 20% of GDP. It's currently at 23%. Some good first steps were taken in the Big Beautiful Bill Act to tighten Medicaid eligibility and the like. If the Republicans crater on this, there's no way back to 20%, government spending being 20% of GDP. It runs through health care. We have to rationalize that. That, to me, is the big, longer-term issue for the Treasury market.
Most people understand that at this point. Barry, great to see you. Thank you so much, Barry Knapp.